Hey everyone, welcome to High School Dropout's advice. If you need subtitles, please click on the subtitle button right here. It finally happened. We have the earning release for Ehang and boom! This happened to our stock. 10% drop after the earning release. You might have remembered that I told you a couple of times in my past videos that I hope for a mixed earning release. It happened. And I'm telling you why I was hoping for the mixed earning release. A mixed earning release will disappoint many paper hand traders and investors, and long-term investors can regain and rebuild their position with a lower average. I added just a tiny position at the moment. From a technical standpoint, we might be able to go even little lower. It might look shocking, but between the current levels of around $26 to $27 and around 20 is no support. So we will see if the stock will build a new support. Anyways, first of all, let me tell you, I'm not a financial advisor. Ask your financial advisor if you should invest in Ehang or not. So please take my advice as entertainment value only. Now let us talk about the mixed earning result I was hoping for. Let us compare the fourth quarter of 2020 with the fourth quarter of 2019 first. The total revenues were about the same as in 2019. 56.6 million RMB versus 54.7 million RMB. So there was no improvement. The gross margin in these 3 months took a little hit of 1.3%, but this is not as significant when your gross margin is 59.4%. One thing that spooks out many short-term investors, traders and paper hands might be this number. Operating loss was 49.2 million RMB, which was 7.5 million US dollar compared with just 2.1 million RMB, which is 25 times less. Ehang described the increase in operating loss due to the increase in share-based compensation. I will talk about this later and show you this cost again later because it's important for us to understand what dynamic it brings to the company. Overall, the adjusted operating costs could not be positive after that amount of operating loss. So Ehang lost 1.6 million US dollar compared with a profit of 3.8 million RMB in 2019. Overall, the net loss was 7.8 million compared to 0.2 million RMB in the fourth quarter of 2019. So we see a quarter over quarter with no revenue gain and with huge losses. This can be a reason for selling, but now let us look at the year-over-year comparison. When we read financial statements, it's good to look at the details, but it's also important to zoom out and see if the overall picture and the basic fundamentals we invest in are still the same. The main direction of the company should not have changed based on a quarter result. So let us check the year over year now. Have a look at the total revenue of 180.1 million RMB in 2020 versus 121.8 million RMB in 2019. This is an increase of 47.8% during a year of lockdown and worldwide pandemic. I think this shows a clearer picture of how well the company did. I'm happy that a big part of the revenue is coming from aerial media solutions. I thought it's a smaller side business, but seeing that it made 10.1 million in revenue out of the 27.6 million US dollar makes me quite satisfied. This means that Ehang can have 2 strong horses to depend on. I believe that a coach can only go as fast as the slowest horse. So it's good to know that the aerial media solutions of Ehang is not their slow horse. I thought it would be the passenger transportation drones that will make 90% of the revenue. The aerial media solution is a waste of resource, time and research and development and cost. So I'm very pleased that I'm wrong and see that it generates a good amount of revenue. The gross margin is about the same. Now let's look at the operating loss, which had an increase of 97%. 46.3 million RMB in 2019 going up to 91.3 million RMB in 2020. The main reason is the increase in share-based compensation, which I will explain more in detail later. So the company's overall loss was over 91.8% higher than the previous year. 48 million RMB in 2019 versus 92 million RMB in 2020. A 44 million RMB difference, which is around 6.5 million US dollar. Let me explain to you what happened and what decision the CEO made. We see that the operating expenses did skyrocket. I have marked it in yellow. We see a significant spike in sales and marketing, which is fine because we need more marketing for more sales, which is the right step for a growth company. We have a slight increase in general and administrative expenses compared to the last quarter, which is fine because the company grows nearly 50% in year-over-year revenue, so having a 10% increase here is totally acceptable. But now, look at the research and development costs. This is a spike of over 150%. I want you to take a minute and think about it if this is good or not. I want you to understand how to read financial reports, so I'm giving you a moment. The correct answer is yes. We want to see this number, and this number is very good. Without research and development, there's no growth, no products, no patents, no edge versus competitors, and no innovation. Research and development are the core for a growth company. In my video about the Q3 report, I said that I wish I will see more expenses in research and development, and I finally got it. Without this expense, we would likely don't see the new passenger drone with a 300-kilometer range. So, the development of the new 300-kilometer range passenger drone was a big reason that the company's earnings look like it's now. But now let us talk about this issue, which I don't feel so good about. The increase in losses was not based on a cash salary, but share-based compensation. So in other words, the CEO decides to pay its staff and mainly the research and development team in shares and stocks. You see that there is a big jump in stock distributions from around 14 million RMB to 54 million RMB if you compare 2019 with 2020. Let me explain this part to you, and you have to make up your own mind if you like this or not. It's common for the company to give shares to their employees, but usually they would give shares to key executives and directors, rarely to engineers and mid-level staff. The CEO is a technical guy and an engineer himself, so maybe he thought that it's nice to give his colleagues shares and stocks of the company. Or perhaps he is short or was short in cash and wants to preserve the cash. I don't know the reason, but the good thing is about giving shares and stocks to employees is that they will increase their loyalty to the company and have the best interest in the company because they own part of it. The bad thing about this procedure is that it can dilute the stock value if Ehang creates more stocks to give it out to the employees. This would be bad for us investors. I have to keep an eye on the total share amounts. I didn't notice that it happened yet, but we should be aware of this problem. There are two flip sides of the coin of paying employees in stocks. It will be a stronger bond between the company and the employees, but a weaker bond for investors and the company. This is the take you should understand. From the financials, I don't see a big issue. The total picture remains strong. Revenue increase of 47.8% is what I'm focused on here. In a year of pandemic and lockdown, it's good enough for me. If I only can choose one number out of this report to know, it would be this one. Now let us talk about the achievements Ehangs achieved in 2020. Trial certificates in Korea, Austria, Hong Kong, partnership with Express Delivery Services, which is part of the State Post Bureau of PRC. So in other words, a partnership with the government. Trial flights around the globe in 8 different countries and 40 cities. A 40 million investment from a European company. And the more flights in the Guangdong, Hong Kong, Macau area. You already know that Hong Kong seaplane will have passenger drones and Ehang is most likely the candidate. With the 300-kilometer drone, flights from Hong Kong to Macau will become a reality. I told you about the Norwegian, UK and France trials, but there are actually more going on. They also have trials in Spain and the Netherlands and have projects in Belgium, Germany, the Netherlands, Greece and the Czech Republic. This is what the CEO said, and I told you that I want to know what his outlook is. This is what is more interesting to me than the numbers. Of course, we know that there will be a new electric vehicle takeoff and landing drone. There will be 100 air mobility routes. However, this will take 24 months, but it will be a milestone. The 100 routes mean several hundred drones and maybe thousands of drones, which will fly and fill the capacity of their production line. The 100 routes will be in the Guangdong, Hong Kong, Macau and Greater Bay Area of China. The most important is they aim to produce 250 units of the EH216 this year. We know the Yunfu plant construction is coming to an end and 250 units are close to the capacity of 600 drones per year. Considering we have mid-April, the production will start with full strength. However, I think it's very conservative that the company expects revenue of 130 to 180 million RMB for 2021, which is the same number like in 2019 and 2020. Based on what we know, for example, the 50 EH216 from Korea and the CEO plan of delivering 250 units, this estimate seems like a strategic move of under-promising and later over-delivering. Another significant milestone is the development of getting a certification. They have established a team that will work on the certification process because this is the first time in China to work on this kind of certification process. It might take some extra time. But based on this news, we see that the team of the CAAC, which is responsible for the certification process of EH216, is highly motivated to get it done quickly. If they get the certification, I think companies which are interested in buying the drone will be more likely to do so. This certificate will be another huge milestone, which is at least so important as the 300-kilometer range passenger drone, which they present us next month. Next month will also be the Investors Day, who can tour their production plant. Overall, the big picture aligns absolutely with the direction we have for the company. And the direction is going up. Anyways, for legal reasons, let me tell you that I'm not a financial advisor. I'm just a guy on YouTube. Please remember to do your own due diligence and hire a financial advisor if necessary. Please like, share and subscribe to my channel when you don't want to miss out any new stock information and investment opportunity. Thank you so much and see you hopefully in the next video. Thank you. Bye.